I will be discussing right now the three final topics in capital market. Those are mergers and acquisition, investment banking, and portfolio management. So let's start for the topic number 1, which is the mergers and acquisition. So the learning objectives are describe the different types of mergers and acquisition, analyze the strategic rationale behind M&A transaction, and the last one is identify the key steps involved in M&A process, including due diligence and integration planning. So mergers and acquisition is a corporate strategy involving the consolidation of companies through various types of financial transaction. It is also strategic activities where companies consolidated or transfer ownerships. Mergers, these are the two companies agrees to combine their operation into single entity. Often with a newly created name, it is often involved companies with similar size, scope coming together to enhance their competitive positioning, achieve synergies, and expand market reach. So acquisition, it is one company buys another company, usually through purchase of assets or its shares. It acquired company may become subsidiary or be fully integrated into acquiring companies. Types of mergers and acquisition. So number 1 is horizontal mergers. Horizontal mergers are combining two companies in the same industry and the same stage of production. This is often done to reduce competition and achieve economies of scale. Number 2 is vertical merger, combining companies at different stages of production or distribution within the same industry. This can secure supply chains or enhance control over the production process. So number 3 is conglomerate mergers. So conglomerate merger is combining companies from unrelated industries. This diversifies the company business and reduces risk. Strategic rationale behind M&A transaction includes number 1 is synergies. So companies often pursue M&A to achieve synergies, which can be either cost synergies, reducing costs through economies of scale, eliminating redundant function, and more. Or revenue synergies, increasing revenue through cross-selling opportunities, expanding market reach, and more. So number 2 is market expansion. Acquiring a company can provide immediate access to new markets and customer bases, allowing to acquire company to expand the geographic footprints of entire new market segment more rapidly than organic growth and would allow. Number 3 is diversification. So M&A can help companies diversify their product lines, services, or market, reducing their reliance on single product, services, or market, and thereby mitigating risk. So number 4 is competitive advantage. Acquiring a competitor or a company with complementary strength can enhance a firm's competitive position, increase market shares, and provide a stronger platform for growth. So number 5 is access to technology and talent. So companies may acquire other firms and gain access to new technologies, intellectual property, or skilled personnel, which can be critical for maintaining a competitive edge in innovative-driven industries. So number 6 is financial benefits. So M&A transaction can create financial benefits such as increased cash flows, tax advantage, or a better access to capital market. Additionally, acquire undervalued companies can provide a financial upside when those companies' values are realized. So the number 8 is the strategic realignment. So sometimes companies engage in M&A to rely their strategic focus, entering new industries and divesting on core business to concrete their main strength. So the number 9 is eliminating competition. So acquiring competitors can reduce competition, consolidate market power, and potential allow to greater pricing power. Number 10 is regulatory and tax consideration. So certain regulatory or tax benefit might drive M&A activities such as favorable tax treatment or regulatory environment to certain regions or sectors. The key steps involved in M&A process. So number one is strategy development. An M&A strategy can help to set clear expectation for all involved. While each deal is unique, any strategy should address what your company is hoped to achieve with the deals that how it will get there. The number one that should be considered in the strategy development is what is the purpose of the transaction. Number two is how will the company acquire the financing for the transaction. Number three is which entity are involved. Knowing who and what is involved and how these pieces are related will help guide the due diligence process. So number two is target identification. So during this phase, legal team must search and evaluate potential target companies. So knowing who and what involved and how these pieces are related will help guide due diligence process. This can be broken down into following steps. Letter A is determine the constituents. If you are looking for a general merger, you will want to identify the target. It's a triangle merger, both target and the subsidiary must be identified. So letter B is identify any subsidiary or related entities. So you'll need to know what they are, what industries they are working in, and where they are located. Also important is whether they are qualified to do business in other states and countries. So the number three is the valuation analysis. To properly evaluate and determine the suitability of the target company in line with the M&A transaction plan, legal teams need to access to as much information as possible regardless the target operation of customers, financial products, and more. So number four is negotiation. Once the valuation models of the target company have been produced, your firms can present and offer and move into the negotiation phase where the terms are discussed in more detail. Number five is conduct due diligence. This is usually the most time-consuming and critical part of any M&A transaction. M&A due diligence require a detailed examination and analysis of the target company from both internal and external sources. This helps to verify the target value and identifies liabilities. Due diligence task is in M&A, so includes searches of UCC, fixtures, filings, and federal state tax liens, and litigation, local and federal, judgment of liens and bankruptcy, IP searches, and etc. The second one is document ordering. So charter documents, all documents on file versus receipt stated forward, records of good standing, long or short form, bring down letters, verbal status checks, credit report, and more. So number 6 is deal closure. So with due diligence complete, parties make the final decision on moving forward to execute the transaction. For legal teams, this comes with several responsibilities. Corporate or pre-clearance filing must be corporate or pre-clearance filing must be made in advance for closing date. This includes mergers filing, amendments, ordering of goods and standing, or issuance of bring down letter. So number 7 is financing and restructuring. Although financing options were explored during this M&A planning process, the final details typically come together once the purchase and sales agreements are complete. So number 8 is integration and back office planning. So managing an integration of an acquired company in the full-time job and should be treated as such. Both parties should work together to ensure seamless integration. For legal teams, this means entity planning and compliance work is localities involved. So the tasks include the following: entity setup, consolidation, and local entity management. The number 2 is governance and structure changes. And number 3 is UBO registration or KYC compliance. Number 4 is annual filings. Number 5 is registration agents address services. And number 6 is legal representation. Directorship services were required. So the number 9 is post-merger compliance. So post-merger integration is often looked but is a critical task by reaching a business as usual goal and is usual to determining factors in success or failure of the deal. So the number 10 is business as usual. So once the merger is complete, it is important to continuously monitor the success of the newly established entity with ongoing good standing and health check to ensure there are no compliance issue. The topic number 2 is the investment banking. So the learning objectives are to explain the role of investment banks in capital market, including underwriting, merger and acquisition advisory, and the financial restructuring. Number 2 is analyze the different financial products and services offered by the investment banks. The number 3 is identify the valuation techniques used by investment banks for the M&A transaction. So investment bank is a financial services that provides strategic advices and financing to the companies, governments, and various other organizations. It also involves helping companies raise money by using securities or providing advisory services such as merger and acquisition advices. Investment banking services also assist the companies in managing their debt, advising the capital market, and offering underwriting activities. The role of investment banking in capital markets. So the number 1 is underwriting. It comprises matching corporation in needs of capital, either in form of equity or debt issuance, with institutional investors. It is the process in which an investment bank, or a behalf of a client, raises capital from institution investors in form of debt or equity. So the number 2 is merger and acquisition advisory. So it refers to the strategic M&A advisory services provided on behalf of the acquirer or the acquiree. It is assigned with the task navigating a client through the complexities of M&A deal to ensure the favorable outcome is reached. It relates to various aspects of the acquisition and sale of the company's assets, such as business valuation, negotiation, pricing, and structuring of transaction, as well as proceeding to implementation. So, number 3 is financial restructuring. So, investment banks are responsible for structuring the terms of capital raising transaction, including the type of securities to be issued and the offering, size, pricing, and timing. And then the number 4 is market making. So, investment banks act as market makers, providing liquidity in secondary markets for stocks, bonds, derivatives, and other financial instruments. By quoting bid and ask prices and facilitating trading activities, market makers help maintain orderly and efficient markets, reducing price volatility and enhancing market liquidity. So the different financial products and services offered by the investment banks. So investment banking products are economic services provided by banks to clients, along with the institutional buyers, companies, governments, and high net worth people. These products help customers manage their economic exposure to several risks, create, control complex financial products, manage debt instruments, improve raise funds, and provide strategic advisory services. So, the number 1 is merger and acquisition. So services are included in investment banking. Through numerous economic transactions, organization and assets are consolidated. They consist of buying assets, shopping for companies together, merging, consolidating, and buying management. The board of directors have to acquire shareholders' approval before approving a merger of corporation. When a corporation acquires another, that merger results. The buying commercial enterprise acquires a majority of the obtained company stocks. So investment banks provide planning and carrying out services for the ventures, mergers, acquisition, and different business reorganization projects. They support customers with goal identification, company valuation, due diligence, acquisition structure, and negotiation. So the number 2 is equity research. A professional in investment banking focusing on equity research conducts evaluation and generate reports on potential investment for customers, providing advice to clients on whether or not to shop for, promote, or preserve their investment in the purpose of equities banking. So the analysts for equity research at investment banks are experts in analyzing unique market or industries. So institutional and individual investors obtain research report and investment advices for the analyst concerning stocks and different equity units. Number 3 is underwriting. So underwriting is a crucial economic function wherein individuals or institutions assume risk related to a venture investment or loan in exchange of premium. Underwriting includes investment activities, evaluating and pricing securities like stocks and bonds. It assesses the company's financial health, growth and potential, and industry trends before recommending investment. So number 3 is underwriting. So underwriting is a crucial economic function wherein individuals or institutions assume risk related to a venture investment and loan exchange for a premium. Underwriting includes investment activities, evaluating and pricing securities like stocks and bonds. It assesses a company's financial health, growth potential, and industry trends before recommending investment. So underwriters additional set up insurance policy in terms of conditions, balancing financial viability and policyholders' needs or expectations. So number 4 is capital markets. So capital markets serve as conduit for financial savings and investment between vendors and recipients for useful resources. So suppliers, who are normally includes banks and traders, are individuals or organizations with capital to lend or invest. Business, governments, and private citizens are the people who look for capital in this market. So the primary and secondary market makes up the capital market. So the stock market and the bond market are the two most popular capital markets. So by bringing suppliers and capital seekers collectively and offering a venue of securities exchange, they aim to increase transactional efficiencies. So capital market are financial exchanges between suppliers and investors, including banks, investors, corporations, governments, and individuals. So they promote financial instruments like equities, debt, securities, divided into primary and secondary market. And then the number 5 is the debt financing and capital structuring advisory. So investment banks helps their clients obtain the debt financing for business needs such as acquisition, operation, and other capital requirements. They offer strategic guidance on capital structure choices, including structuring troubled debt, refinancing current debt, and minimizing the ratio of equity debt. When a business sells debt instrument to provide institutional investors, it raises funds for working capital or capital expenditures. This is known as debt financing. The individual or institution become creditors in exchange for lending the money, and they are guaranteed repayment for the principal amount plus interest. So the number 6 is risk management. So risk management is the process of detecting, evaluating, and mitigating risk to an organization assets, profits, and operation is known as risk management. Many factors such as unforeseen financial circumstances, legal responsibilities, technological problems, poor strategic management, mishaps, and natural calamities and might contribute to this risk. So the organization can better evaluate the whole spectrum of risk it faces when it implements successful risk management programs. So the relationship between various company hazard and potential domino effects they may have in organizational strategic objectives is another topic covered by risk management. So the number 7 is trading on sales. So Sales and trading division manage the purchase and sale of financial goods to give investors liquidity. So in this market, equity or shares of ownership in corporation is the most traded security type. Publicly listed firms, little startup, and big international corporation can also provide equity shares. So debt instruments including government, corporate, and mitigate-backed securities as well as derivatives are example of other securities. Number 8. So corporate advisory. So corporate advisory services is essentially a catch-all word to expert counsel supplied to company houses with the help of advisors with knowledge. Accounting and forensic accounting are included in the corporate advisory, which is primarily concerned with strategic corporate finance. In addition, it includes an intensive and in-depth examination of data and factors that influence it. Number 9. Bonds. So bonds are debt instruments utilized by government and companies to borrow money for the infrastructure, business growth, research, and development. They allow individual investors to act as lenders, allowing them to sell bonds or buy them after the original issuing organization raises capital. So public debt market permits thousands of investors to lend or buy bonds. So the number 10 is investment funds. So investment funds is a pool of money that several human beings pull together to buy securities, with each participant retaining ownership and managing his stocks. Number 11 is leverage finance. So in the arena of investment banking, the term leverage finance describes as issuing of debt securities to fund M&A, LBOs, and investment-related activities. It entails lending money to corporations which are heavily indebted and who need engage notably leveraged transactions, usually composed of combination of senior and subordinated debts. The leverage financing is backed using the assets of target firms, or in the event of leverage buyout, the assets is acquiring company. Number 12, the restructuring investment banking. So the restructuring investment banking assets companies or debtors, which transaction involving capital structures modification to ensure their survival. They also assess the bankruptcies, liquidation, and distressed sale. In some cases, they may provide advices to creditors on each transaction rather than the debtor. The other topic is valuation techniques used by investment banks to evaluate companies for M&A transaction. So, valuation methods for merger and acquisition are important for figuring out fair prices, negotiation deals, and getting financing for following rules. The number 1 is comparable companies analysis. Or comparable companies analysis involves identifying publicly traded companies in the same industry with similar growth prospect and economic characteristics. The number 2 is precedent transaction analysis. So precedent transaction analysis entails identifying recent M&A transaction involving similar companies. This method analyzes the deal's multiples paid in this transaction, adjusting to difference in size, market condition at the time of the deal, and anticipated synergies. Number 3 is discounted cash flow. So the DCF method starts with forecasting the future cash flows of the business or asset being evaluated. This cash flow represented the net amount of cash that is expected to receive over the expected period. The number 4 is adjusted book value method. So this method assists the company value based on the balance sheet, adjusting for assets and liabilities of market values. This often involves evaluating assets such as real estate, equipment, and inventory. So the number 5 is liquidation value. So liquidation value method estimates the net cash that would be received if all assets were sold and liabilities settled. This value is typically lower than other valuation methods as it assumes assets are sold under distressed condition. Number 6 is replacement cost method. So replacement cost method calculates what would be cost to replace a company's existing assets with identical new ones to current market prices. This method provides the value base of the current cost of the asset without considering depreciation. The number 7 is leverage buyout analysis. It is a popular financial strategy in a merger and acquisition wherein a company is acquired primarily with use of debt and finance the purchase. The significant portion of the purchase price in an LBO is funded through debt, which can include bank loans, bonds, and mezzanine finance. The number 8 is contingent claim valuation, also known as real option valuation, is a sophisticated method used to assess the value of investment opportunities that are contingent upon certain outcomes. The third topic is portfolio management. So the learning objectives is explain the process of constructing and managing diversified investment portfolio, evaluate different asset classes like equities, bonds, and alternatives and their suitability for different investor risk profile. The number 3 is analyze and select investment vehicles such as mutual funds and ETF for portfolio construction. The process of constructing and managing diversified investment portfolio. So the number 1 is clarify your investment objectives. So begin by defining your investment goals, whether you're planning to retirement, saving for your kids' college, or seeking to reach other financial milestones. Number 2 is establish asset allocation. So asset allocation involves dividing your capital into various investment categories or buckets. Start by considering allocation to stocks, bonds, and cash. The optimal allocation depends on the risk tolerance of investment horizon. So the number 3 is selecting asset classes. Delve deeper into asset class selection, focusing on diversification with stocks or bonds. Diversify across industries, sectors, and geographical region in equities, and explore mix of governments, corporate, and municipal bonds in fixed income, varying in maturities and credit qualities. So the number 4 is choose investment wisely. So once you've done determine asset classes, selecting individual investment becomes pivotal. Exchange-traded funds and mutual funds offer diversified exposure to specific asset classes. So the number 5 is regular portfolio rebalancing. So maintain diversification by periodically rebalancing your portfolio. Rebalancing involves restoring your asset classes to their original allocation percentage. So the different asset class and their suitability in different investor risk profiles. So asset class refers to the type of underlying investment you can make, whether directly through stocks or bonds or indirectly through mutual funds or exchange-traded funds. So there are traditional assets classes. Those are equities, fixed income, and cash equivalents. There are also alternative asset classes like commodities, real estate, and hedge funds. So one of the asset class is equity or stock. Having equity in a company basically means owning a part of it through stocks and shares. This earn money is in several ways. Most simply, when the company's stock price rises, your shares are worth more. The suitable investor risk profile for equity is the moderate risk profile. The investor with a moderate risk profile are willing to accept a certain level of risk in exchange for potentially higher return. And also the aggressive risk profile. So investors in an aggressive risk profile are comfortable with taking a higher level of risk in pursuit of potential higher returns. So the second asset class is bond. A bond is essentially a loan made to a company or government when it needs to raise money. Each bond has a predetermined lifespan or maturity date. It is also interest rate that agreed to in advance or referred as a coupon. So the suitable investor risk profile for bonds is the conservative risk profile. The third asset class is alternatives. So an alternative investment is an asset that is considered to be outside of the traditional asset classes of equities, bond, and cash. The alternative is a very broad term for encompasses a wide variety of investment, including everything from real estate such as farmlands to listed infrastructure funds or open-ended hedge fund strategies. So the suitable investor risk profile for alternatives is conservative investors, moderate investors, and aggressive investors, and income-oriented investors and growth-oriented investors. It also includes capital preservation investors and balance investors. The fourth asset class is cash. Unlike real estate, cash can be bought and sold easily and quickly. So no need to check property lines or hire structural surveyors with dollar and cents. Investor can earn interest on money market funds, but it will generally be at a very low rate. So, investment vehicle for portfolio construction. So, investment vehicles is a product used by investors to gain positive returns. So, investment vehicles can be below risk such as deposits or bonds, or they can carry a greater degree of risk such as stocks, options, and futures. One of the investment vehicles is stocks. Stocks is an ownership stake in a company. So, you can buy and sell stocks in units called shares. So your stake in a company depends on the type of stocks and how many shares you own. When the stock is price company increases, so does the value of your shares. Many companies also pay a portion of their profits called dividends to stockholders. The number 2 is exchange traded funds, or is another type of investment fund. It's similar to a mutual fund in that it pools investors' money and allocate it across investments. So the main difference is how it traded. So ETFs are traded in stock exchange, just like stocks. Mutual funds are purchased from mutual funds issuers, and prices is set once per day. So number 3 is bonds. So a bond is a debt obligation that you can think as a AOU. Corporation, local government, and federal government issues bonds to raise money. When you buy bonds as a personal investment vehicle, you're lending the money to the bond issuer. So the number 4 is the target date funds. A target date fund is a type of mutual funds created for specific retirement year. The portfolio manager balances the plan's asset allocation to optimize its retirement year. So the number 5 is mutual funds. A mutual funds pool investors' money and invest it for them. So depending on the mutual fund, investment may include stocks, bonds, or a mix of the two. This means that mutual funds are inherently safe or risky.